What do most traders do after a loss? They panic. And that's exactly why they keep losing. They let one bad trade shake their confidence, cloud their judgment, and destroy their next trade. But what if I told you that how you react to a loss is actually more important than the loss itself? That's how this guy turned what could have been a horrible trading day into $37,000. Let's see what we can learn from my man Jade Cap.
I just had one of my biggest trading days ever, making $37,000 in a single trading session. In this video, I'll break down exactly how I did it. We'll cover the strategy I used, including entry criteria, stop loss and targets, the risk management, and when to change bias. But enough of the talk, let's get right into the video. I try to keep things as simple as possible. First thing we're gonna do is identify our key levels. All right, so is the market respecting old highs and old lows? This is extremely important. You know, is the market creating higher lows? You know, and is it respecting these old lows? Also, in an uptrend, we might see short-term lows being ran out and then still respecting. So those are the two key indications that I'm looking for when I am leaning bullish in a market, and vice versa. Okay, are we respecting those old lows or old highs? And are we running below old lows, short-term lows, and then rejecting, or running above short-term highs and rejecting? The next thing is...
Okay, so there's one thing I want to add here, which is extremely important information, and that is, in order to be able to use this effectively, what he's talking about, you have to be able to tell the difference between a trading range and a trend. He's talking about a trend, but very often the market is not in a trend, it's in a trading range. And all charts, I don't care what you're trading, whether it's futures, crypto, all charts and all time frames have two different modes: trading range or a trend. So this would be trending up, this would be trending down, okay? But there's a thing called a trading range, which you have to absolutely be able to know as well. I want to show you an example of this. If you look at this chart, your eyes need to be able to look at what's happening right here and to be able to say, this is a trading range, okay? This right here, and this is a trend. So in order to do what he's saying, you have to be able to tell the difference between these two things when you're looking at a chart. Otherwise, what he's saying won't actually work for you. Make sense?
Is the market respecting fair value gaps? Okay, so if you guys don't know what a fair value gap is, it's essentially a 3-candle pattern where we have this candle here. All right, I'm gonna draw a bullish fair value gap. Then maybe we get a candle like this. Actually, let me draw it like this. All right, this is the open. We get a candle like this, okay? And then the third candle creates something like this, where we don't fill in the prior candle. So as you guys can see, we have a gap in price. So we have this, between this high and this low creates a fair value gap. So this is our FVG, and vice versa if you're bearish. So this is giving me an indication that order flow is continued bullish. Then, do I have a clear target?
This is also called a breakout point. So I just want to point this out, because if you're an ICT trader, you call this here, right here, a fair value gap, FVG, right? But if you're an Al Brooks student like me, we just call it a gap. Now, it's basically the same thing, but I just want to add a little more detail here, because this is something important to know when you are identifying gaps. And that is that this is a breakout point, okay? Now, why is this a breakout point? Because this was the prior high. Before this candle here, this was the prior high, right? So this is called the breakout point because this was the point where the price broke out above that prior high. Now, that's part one. Part two is what happens after there's a breakout. So after a breakout, what you will see is the market often, very often, goes back down to test that breakout point to see how strong those buyers are. And if the market doesn't get there and it reverses up instead, it leaves an open gap, okay? So Al Brooks traders would call this an open gap. So I'm just adding a little more detail because what you want to know is why what you're seeing is happening, not just that it's happening. So yes, there's a gap between this high and this low, but the reason why is because this was a test of how strong the bulls were. The bulls got this very big bull bar closing on its high, showing very strong conviction from the bulls, right? But then what happens then is the bears come back and test the bulls and say, okay, how much conviction do you have? It's probing. The market's coming down here to probe and see how many buyers there are down here. And there were so many buyers that the bears could not even get down to that breakout point, okay? So this is a way, listen to this. This is a way to assess how strong the breakout is. And if you're going to be trading with the trend, which is what he's saying he wants to do, which is probably what most traders want to do because it's a good high probability way to trade. It's how I like to trade most of the time. Then you want to be able to tell the difference between a weak trend and a strong trend. Then let me just give you the TLDR, too long, didn't read, about what I just said. A gap is an indication that the price is trending and the trend is strong. Okay.
So when I'm trying to pick a target, it's either going to go to liquidity or inefficiency. So if you're trading with the trend and the trend's going higher, then it's okay to target previous highs. But if you're counter trend trading, and I want you guys to take note of this, then it's different. You are probably only going to target inefficiencies because it's not going to go to those old highs or old lows. So let's just say, for example, the market's going higher. All right, the market's going higher, and you're trying to target one of these old lows. But the problem is there's a fair value gap that's resting here. So instead of you targeting the low as a counter trend trader, you really only should target the fair value gap, because in an uptrend or a downtrend, it should not go to those old lows. And that's why it makes your targets low probability.
Right, because the bulls continue to get higher lows. So he's just saying if a trend means that you are getting higher lows, then you want to work with that.
So those are the three things that I really look for to keep things very, very simple. When I'm looking for a trade setup, do I have a bias? Are we respecting this order flow? Right, so we have fair value gaps. And do I have a target as far as liquidity or inefficiency? If I have all three of those things, then I have a trade setup. Okay, so let's break down the trades that I took. Okay, so the first trade that I took was a long in YM. Now this trade, in my opinion, extremely, extremely obvious. At the time of this recording, we have not taken out those all-time highs, although we are very, very close to it. So what we're looking at are these equal highs here. Okay, so like when I mentioned the target, I'm looking for extremely clear levels of liquidity that make sense. Not only that, but
ICT traders call this equal highs. Al Brooks traders will just call this a double top. Either way you slice it, it's a top. The market made a top, right? The price tried to get past this point once, twice, multiple times, and the market said, in this case, the sellers said, nope, this is a level. They were defending that level. They've got their soldiers out and they're like, you are not coming past our gates. You are not coming past our gates, okay? So the bears were just protecting this area, and that's why the price refused to go past that area. And then what happens after that happens 1, 2, 3 times? The price usually goes in the other direction, okay? So that's when you see this. Now, he's gonna use this as his profit target. So keep watching because we'll see why this is an excellent choice for where to put a profit target.
we're respecting these lows in here. Okay, I wish I had more data on my charts, but I don't. And we're rejecting away from short-term lows. So you guys can see here, we're taking out liquidity, but then it's...
By the way, I just want to go back to that 1 second, because if you're new, this is for the new traders. This is one of the most obvious patterns to be able to identify. So if you're new and you're looking for some patterns to practice being able to identify, to train your eyes to see these things on a chart, start looking for a double top. Or if you're ICT, these are equal highs, okay? Equal highs, double top, call it whatever you want. This is what it looks like. It's when the price gets to an area and then gets to that same area or almost exactly identical, right? And boom, boom, then you have that double top, okay? So start being able to identify those on a chart, either double tops or double bottoms, which would be the same thing, but the opposite.
Oh, so you guys can see in here, we're taking out liquidity, but then it's completely rejecting the other direction. So all the indications right now are for price to go higher. So my bias is bullish. All right, and this is my target here. So when I drops down, this is an hourly chart, by the way. So this is my higher time frame analysis. I think we're going to trade to this level.
Okay, and just to be clear here, he's using top-down analysis, which means he's going to start with a higher time frame, then he's going to go down to a shorter time frame, then he's going to go down to a shorter time frame, and finally get his entry. And he's looking for a story that's consistent from time frame to time frame to time frame. So he has multiple data points to confirm what he's seeing.
So my lower time frame. All right, I'm going to break this down for you guys.
Now, remember I just pointed out double tops and I was saying practice those? Here's an example of a double bottom. Look, same thing, but in the micro. Okay, so we were zoomed out and we were looking at a double top. Here's a double bottom, see? Because we came down here and then we came down almost to the exact same point. So double bottom here because one bottom here and one bottom here. All right, same pattern as before, but in reverse.
All I need to see is a displacement away from these specific levels. I don't need to see everything. I'm not plotting all the levels on my chart. Okay, I'm just looking at the levels that really stand out to me and really make sense to me from an order flow perspective. So what I'm looking for is just this fair value gap to be respected. Okay, and I don't really need other analysis to add into this. All I need to see is that the last hour, right? The last previous, and these are hourly candles, by the way, these candles on the right here, and this is a 15-minute time frame. So
okay, so it's a little bit confusing, so I just want to point this out. These are the 5-minute candles, and these are the 15-minute candles, and he's got them right next to each other, so it's a little bit confusing, but just know that he's comparing the two. He's looking at the same data from two different vantage points, right? The same thing as looking at something really close and then looking at the same thing further away, okay? Same thing, but with the charts.
You know, one of these candles is showing you 4 of the 15-minute candles. So all I need to see is the previous hour closed extremely bullish. We had this bullish displacement. And then all I'm looking for is a retracement into this fair value gap. You guys can see that it's also trading into what? A 1-hour order block. All right. I have my stop loss placement here, which is roughly 50% of this level of these down closed candles. And then I'm just targeting, I believe this is a 1 to 2.
Okay, so he put his profit target right around that area where we marked it out before. And so that was the first thing he did. So his profit target's somewhere around here. So he's saying he wants to sell. Now I told you why. We're going to look at why this would be a good area to put your profit target. Because if you're buying, if you're long, which he is, then your profit target means where you're going to sell. Okay. And so he's saying he's going to sell around where they were selling before. Now, there's 2 reasons why this is a solid profit target. Number 1, because they were selling there before. That means the institutions or smart money is selling there. If the institutions are doing something, it's a good idea to get with what they're doing because those are the whales that move the market. Market makers are moving the market. So you want to move with where the market's moving more often than not. Okay. So that's reason 1 why it's a good place to put a profit target. Reason number 2 is because he just said his risk to reward ratio is 2 to 1 there about. Okay. So if you are structuring your trades based on solid risk to reward, that's a very solid, rational, data-driven way to assess how to take profits. And this is literally the difference between profitable traders and not profitable traders. Profitable traders have good risk to reward ratio. Unprofitable traders do not. So if you practice by structuring your trades on a trade-by-trade basis with good risk to reward, meaning your reward's bigger than your risk, that's good.
These lows in here. Okay. I wish I had more price to go higher. Frame. All right, I'm gonna break this down for you guys. All I need to see.
Okay, so what I see here is that the market was going up, right? We can tell that there's an uptrend here, right? Why? Because higher highs and higher lows. Boom, we could draw a line connecting these lows and boom, you see it. You can see it, right? That's moving up. And then we went sideways. All this in here. Remember I said trend trading range? Here's a trend. Boom, right here. Here's a trading range. Why? Because we're just going sideways, right? Traders call a trading range sideways because it's going up and down, but it's just kind of staying in this range, boxed in, okay? And then here we start moving up again, okay? And then where he's getting in is after the price is pulling back into this area, looking for confirmation of trend continuation. So his trade is on the premise, we can see that his trade is on the premise that the trend will continue. So he's going for trend continuation. And what's great about this is he's telling you very specifically what his criteria are that he needs to see happen in order for him to enter the trade, which are confirming that that trend continuation is likely. And he saw it. And you can see it too here. Can't you look? There's tails on the bottom of these candles. We came down here and the price rejected out of that area and raced up once. It happened again here, and then it happened again here, okay? So this is showing you that there's a lot of buyers in this area, and that although the bears were able to push the price into this area, there were so many bulls buying there that it shot the price right out of there as soon as it bounced in there, which shows you strong support, which means probably a good idea to get long. And again, that gap, he's using the gap as a way to visually see what I just explained to you.
Looking at the levels that really stand out to me and really make sense to me from an order flow perspective. So what I'm looking for is just this fair value gap to be respected. Okay, and I don't really need other analysis to add into this. All I need to see is that the last hour, right? The last previous, and these are hourly candles, by the way, these candles on the right here, and this is a 15-minute time frame. So, you know, one of these candles is showing you 4 of the 15-minute candles. So all I need to see is the previous hour closed extremely bullish. We had this bullish displacement. And then all I'm looking for is a retracement into this fair value gap. You guys can see that it's also trading into what? A 1 hour order block. All right. I have my stop loss placement here, which is roughly 50% of this level of these down closed candles. And then I'm just targeting, I believe this is a 1 to 2.
Solid. Okay, great.
And here's the final result. So,
okay, now this is the trade on a 5-minute time frame, I believe. Okay, so what we can see here, and I think we can draw on this. Yeah, okay, great. So what we can see here is that his first entry was here. You see that? First entry was here. Now, this is excellent because we have some sideways price action here, right? And then we have trend continuation here. Then the price broke out of here. Remember what I shared with you at the beginning of this video? I said he's calling it a fair value gap, but you could also look at it as a breakout point. Why? Because this was where the area broke out of. Look, this was where the highs were previously, right here and right here. And then the price broke out. So that means the point of the breakout is right here. And then what did I say is the second part of that? It's 2 parts. Part 1, you have a breakout, you mark out where the breakout point was. In other words, here, the prior highs. And then often the price comes down to test that breakout point. And that's what happened here. So this is the bear saying, we're going to test you bulls and see how strong you are. And as soon as that happened, there was one bear bar closing on its low, which is a big bear bar. So I'd be concerned if I was bullish if I saw that. But then look at what happened. The bears failed to get follow through. So you want to look for signs of momentum. Just because the bears are able to get one big bear bar on the chart doesn't really mean anything. You need to see how much conviction do they have. And that's called follow through. So look at the second candle and then see how big and strong the second candle is to the first candle. Look at the second candle is not even half the size of the first candle, okay? So what that shows you is waning momentum, not increasing momentum. Now, if this second bear bar was as strong as that first one, then we'd be worried. However, it stopped short right here where that breakout point was. And then look what happened. The bulls bought, and this is right where his entry was. So this is an excellent entry because what it means is that the bears got into this territory, but then the bulls bought, and he bought as soon as you saw a bull close. And I like this entry because it's saying, I'm not going to assume that I'm correct. I'm going to sit back like a pro, sit back like a professional, and I'm going to wait for the market to confirm what I think, then I'm going to enter. So if your premise is that the market's going to go up like this, but then the market's going down, okay, then you need to wait for data to confirm that the market is continuing up. And that's this bull bar closing right there, showing now we have a higher low. You see that? So now that the market has resumed back up, he's entering here and he is going in with the 2-to-1 with the stop loss down here. Solid entry, and it's data driven, right? This is not magic. This is trend trading, which is one of the most reliable strategies you can do. And what is he doing? He's getting in on trend continuation after a pullback, which is, I think, probably the most solid setup there is.
Obviously, you guys can see where the candle was originally. So here's our hourly candle here.
And just to clarify one thing, trend continuation in a strong trend, when you see a strong trend, trend continuation has sometimes up to a 90% likelihood. Okay, so that's why this is one of the best setups there is.
As the trade's going on. Well, then look at how I closed. Okay. So these were all signatures that I'm looking for when I'm trying to position myself in an hourly candle. I want to see it actually open up and trade lower. Okay, it opened up, traded lower into what? A fair value gap. I'm going to place my position long with the expectation that the hourly candle is going to close bullish, which it did.
So he knows what he's expecting after he's entering, which is good, right? You want to say, okay, what can I expect once I enter the trade? So that way you can double check and follow through. That way you're not just hoping. Remember, hope is not a strategy.
Okay, and then the next hour. So at the top of that hour, I sold 10.
And just to be clear, it's confusing. He didn't really explain this. He mentioned it briefly, but these are hourly candles. And he's edited in here so that the hourly candles are right next to the 5-minute candles, which is awesome. So again, we're seeing the same data from two different vantage points. So this is the 5-minute, these are the 5-minute candles, and these are the 1-hour candles. And look how strong the trend is. I mean, just look, the candles, the bar bodies are stacking. So here's another sign of momentum. If you see that the bar bodies are stacking, and here's a little tiny detail that you can notice. Look at the high close of this bull bar, okay? And look at the start of this body. So do you see that there's a tiny gap between this and this? I think I can actually mark this out for you. Yeah. Okay, so look. Do you see how there's a teeny tiny little gap here? Okay, that actually shows high conviction. So that's a very good sign that the trend is strong. And notice there's not actually one here, not that I can see anyway, but the candles are not overlapping. The bar bodies are not overlapping. Do you see that? So the fact that there's a small gap here and then here, there's no gap, but they're not overlapping. Again, that's showing you strong conviction on the bulls, which means this trend is continuing to show momentum to the upside. Those are the things you want to look for on your chart. When you're trading and you think the market is heading in a direction, these are the ways to either confirm or deny what you think, which is very important. You need to look at the chart and learn how to use the data to confirm or deny, both very important information of what you think.
Contracts, and I left 5 running. So you guys can see that I bought 15 here, sold 10 of them, and left 5 running. And as this market was going higher, adjusted my stop loss. Right? I don't need to get the full target out of this trade. Okay, that to me is just being greedy. You know, if it gets this close, I'm just going to collapse the trade. Okay, I had a bias, the order flow was being respected, and I had a clear target. So going over the target again, it's all the way up here, these all-time highs.
So again, that was his target, and he had 2 reasons for the target being there, which is awesome, right? Anytime you have 2 reasons, at least 2 or 3 reasons for doing something, but at least 2 in trading, you're in a good place, okay? So there's that area where they were selling before. So that's a prior resistance area. So he's saying, I want to sell where they were selling before, but then also it fell in line with where the 2-to-1, 2 times his risk, okay, 2-to-1 risk to reward ratio, right at the same point. So you got 2 data points coming together for that profit target.
Extremely clear target. The order flow is being respected, market structure is being respected, and I have a very clear trade idea.
Very clear trade idea. And also, one other thing I want to point out that he sort of glossed over, and this is really, to me, the whole point of sharing this video with you, which is what we opened with. What did he do? Adjusted. He adjusted, okay? Now, this wasn't his loss. His loss is coming next, so stay tuned for that, okay? That's coming up right after this. He's going to show his actual loss. But what he did is he had an idea, and then he's like, you know what? I got almost all of my target, and I closed the trade, and so I'm happy with that. Now, you have to decide what your strategy says to do. Okay, so maybe you need to hold for that profit target. It really depends on what your strategy says. But what I like is he's saying, I'm willing to adjust. I'm willing to adjust. I'm not going to be rigid. I'm willing to adjust. And that's very important. And that's going to be a theme you're going to see when we get to this next trade where he's actually going to show a loss.
One thing to note is how we rejected the previous hour. So like I mentioned, how we ran below this old low is extremely important. Because if the market were bearish, why would we go below that low and then expand higher? And that's really all the indication that I need to understand that this market is going to continue higher. So once we get the rejection, right, I'm buying on the fair value gap, retracement on that next hour. And then as it's going higher, it's giving us possible areas to add into the trade, although I didn't. This signature here is really all I'm looking for. This signature of rejection.
Here's his actual loss. Let's get into it.
Now, just like trade number one, it had all of the criteria that I was looking for. Okay, so we had a run above this buy side liquidity, failed to displace higher. We got an inverted fair value gap here.
Okay, now pop quiz if you're listening. Pop quiz if you're listening. What is this? This and this. He's got a line drawn here and he's got a line going here, okay? So what is this and this? Pop quiz, put it in the comments. If you're watching this right now, what is this? This is a pattern that I recommended new traders learn how to identify earlier. So that's the hint that I'm giving you. What is it? Waiting for it. 3, 2, 1. It rhymes with schmubble schmop. It's called a double top. Look, because we went up and there's one top here and then another top here. Okay, he calls it equal highs because ICT traders are special. But if you're everyone else, you call this a double top. Why? Because there's a top here and a top here. And so it's one of the most reliable patterns. However, for him, it didn't work out. He lost, and he's going to show us why and how.
Here, so it's already showing me that the order flow is possibly changing and turning bearish. Not only that, we have a new day opening gap here.
Now, why is that? Okay, because this is one of the clearest signs of momentum, consecutive candles. Here we have a double top, which we just pointed out to you, and then you have 1, 2, 3, 4 consecutive bear bars showing momentum to the downside. So that is a sign, a clear sign of bearish momentum. However, the devil's in the details.
Okay, so my target was a very clear inefficiency that I was targeting to the downside. And as you guys can see, I wasn't risking a whole lot to make this trade.
Okay, now with this trade, here's why I would not be short here. It's a reasonable short. It's a reasonable short. But here's why I would not be short here. Because there's a rule, okay, and this is compliment Al Brooks, that if you're in a strong trend, now this is a very strong trend. Do you see how this is essentially parabolic, almost going straight up? In a strong trend, you want to wait for 1, a break of the trend line, and 2, a retest. Okay, a retest, in this case, of the high. So this is a strong trend, and this is what you do. You wait for these two things before considering reversing. It's a solid and reliable rule that will help prevent you from losing money. Again, if you are going to bet against the trend, in other words, you're going to try and predict a reversal, you should wait for 1, a break of the trend line. So here's the trend line, right? We can see here's the trend line. You can just kind of see the lows are getting higher. Okay, so you want a break of that. This is the first break of this parabolic move up here. So we haven't gotten a break of the trend line and a retest of the highs. Now you could argue we had that earlier, but I would want to see it actually more recently. So he's getting short here, which again is reasonable. But if you use that rule, if he used that rule, it actually would have saved him from losing on this trade.
So this trade ended up being a loser. Now, I had an issue with the trade copier, so kind of disregard one of these entries because
Okay, now I want you to watch how he adjusts because he said he just lost a trade. Now let's watch and see what he does in the face of a loss. Very important. Pay close attention here.
Pretty much sold it and then bought it back right away. So you guys can see that I sold it at 21,878.25 and then I bought it back at 21,878.50 because I recognized that it wasn't copying to all my accounts. So this entry here, sell to at 21,880, was the actual entry. And off of the open, it started to kind of respect that level. So I actually entered a little bit early, but you guys can see that I had to sit through a bit of drawdown before it actually started rolling over a little bit. And then once it rolled over, I moved my stop loss to this high. So you guys can see that eventually I took a stop out here. Now you're probably wondering, Kyle, you just had a winner. Now, how much did you lose on this trade? So let's break down the risk management. And I'm going to just talk about this using a futures example. So let's just say you have a $150,000 futures account. All right, and for purposes of this example, I'm only going to talk about Top Step, which gives you a 4,500 trailing end of day, which means, you know, at the end of day, it's taking a snapshot of your account, and based on where your account is, you know, up or down, it's going to trail that. So your highest equity point, let's say your equity high is all the way up here at 153,000. Well, it's going to give you it's going to give you $4,500 in drawdown from that highest watermark point. So if your balance at the end of the day is 153,000, right, then your max loss is going to be what? 149. Is that right? Or is it 148,500? So your max loss on that next trading day is going to be 148,500, right? Because that's what? $4,500 from your highest equity mark. Okay, so when I'm thinking about my specific risk management, I really only care about how many trades can I possibly take in a row without blowing up that $4,500 trailing end of day. Now, you guys can do this a little differently, and some people will recommend, oh, risk 1%, risk 2%, risk 0.25%. The reason I don't like doing that on futures accounts is because sometimes the trailing end of day drawdown is very, very tight. And with a firm like Top Step, I believe they're only giving you like 3.5% of drawdown, okay? So if we just... it's not even 3.5%. So Top Step, this 4,500 trailing end of day is not even 3%. So if you try and do 1% risk, you're going to blow up your account in 3 trades. Okay, so the way that I do it is I take this $4,500 and I say, okay, what is my max losing streak? And let's say my max losing streak that I could possibly sustain is 5 trades. Well, I don't even want to go on this max losing streak and then blow the account. What I want to do is give myself more of a buffer. And let's say if I want to give myself 10 trades. So if my drawdown is 10 trades before I blow the account, then that allows me to risk how much? $450 per trade. Now, this, I would say, is still pretty aggressive for most traders, because you will possibly go on streaks where you're losing 2, 3, maybe even 4 trades in a row. And then once you're down that much, right, it really has an impact on your psychology. So I would even recommend,
unless you're this guy, or unless you are a trader with that professional mindset. So we're going to see how it didn't affect his mindset and how he adjusted instead, which is the key takeaway from this video.
to risk even less. All right, maybe $250 a trade. Because when you're doing this, you know, $250 a trade with $4,500, now it's gonna really take you how many trades before you can lose it. I believe it's 18 trades before you blow the account. So you could, you know, draw down, you could go on a bit of a losing streak and still not have to worry so much about blowing the accounts, right? If you lose 3 or 4 in the row, it's not the end of the world. You guys can always pick yourself back up and get yourself in sync and then take that next trade, all right? All right, so we're 1-1 on the day, but we're not done yet. Now, you're probably gonna ask, what do I do after a loss? And that leads me into my next point, is when to flip bias. So, as you guys can see, we took a loss trying to short this inverted fair value gap. All right, coming back to this.
All right, trade number 3. So this is adjusting after a loss. Now, the first take home point here is that he is very, very, very clear on his risk management rules, so that he knows that he is not sweating if he takes a loss, because he's done the math. Do the math, people. So that way your psychology is not wrecked.
Same chart. This was the 4-hour fair value gap I was mentioning. But if we drop down onto the hourly time frame, we can see that we have now what? We formed a 1-hour inverted fair value gap. So going back to the original, you know, criteria, what I'm looking for, you know, are we respecting these fair value gaps? Once they're disrespected, now all of a sudden I have a possibility to change my bias and expect that we're going to see higher prices. Okay. So here is what I was looking for. I was looking for this buy side liquidity, and then eventually all the way up here. So if we drop down into the lower time frames, okay? This is kind of what I'm looking at. So look at this hourly structure. The past couple hours, and you know, I didn't enter right away right after this hourly candle. What we're looking at is this candle here. Okay, so this hourly candle, I entered on this one here that turned bearish. So this candle here, you guys can see that we have a candle that doesn't have a wick on top of it. And that is really my draw on liquidity for this hourly candle. So what I'm looking at is us, you know, are we respecting those old lows? Yes. Are we rejecting liquidity? Yes. Okay, so what I'm looking at is us just retracing straight off the open. So here, trading lower, all of the open. This is my power of three that I'm looking for. Okay, so we're taking out some equal lows in here. So these are the equal lows I'm looking at.
Or double bottom.
And we have a 15-minute fair value gap. Not only that, but we have the hourly low that's back here. So what I'm looking for is if this bullish price action based on that hourly inverted fair value gap is going to be valid, then I don't want to see it take out that previous hourly low. All right, so I'm targeting this candle here that does not have a wick. All right, so when we're changing bias, we have to understand that signatures need to be in place in price action for us to go long.
Now, what he means by signatures is confirmation signals, which is awesome. You got to know the things you're looking for, as I've been saying this whole video, to confirm or deny what you think.
Yeah, so not only that, we have the fair value gap here, right, that we're keying off of. So this fair value gap is not drawn on the chart right now. I'm going to extend it in time. This fair value gap is really my basis for this long position here. And you guys can see that, you know, as I entered this position, right, I'm relying on time to send this candle above that previous hourly wick. And as you guys can see, we eventually made it above that candle that doesn't have a wick, and we eventually traded to this high. And you guys can see here the P&L screenshot from taking all three of these trades.
We've gone over a lot in this video.
Okay, so he stayed cool, calm, and collected, all stemming from the fact that he's done the math and he knows how much risk he can take on per trade. So you have to ask yourself, is your ability to react and adjust properly after a loss a function of your psychology, A, or B, a function of your risk management? Now, you tell me in the comments which one you think is more important for handling losses. Which do you think is more important for handling losses? If you had to pick A, your trading psychology, or B, your risk management. Pop quiz, okay? Which one's more important? And I would argue the answer is both. However, if your risk management is not done properly, then your psychology doesn't stand a chance. So if there was one that was the most important, it would actually be risk management, because if you screw up your risk management, there'll be zero chance. You understand what I'm saying, guys? Now, if you want more information on my strategy, go to the link in the description, tradesbybren.com/3setups, and I will share with you a document where I break down the 3 patterns that I look for. These are my 3 favorite trades. Also, how I set my stop loss so I limit my risk, and where I set my profit targets so I can get out before it's too late. So if you want inspiration for your trading strategy, maybe that's something you want to look at. And if you are interested in more videos like this, hit that subscribe button. You can also check me out on all the socials at Trades by Bren. And next up, I recommend you watch this video on your screen right now. Click or tap on the screen to watch that, and I'll see you there.